Are you feeling ignorant about your own hotel's financial well-being? Would you be able to detect danger signs in the financial health of your hotel? Were you aware that picking up these danger signs in your hotel's financial well-being is a critical skill for a hotel manager, and it is guaranteed to get you elevations and promotions, ultimately success. However, most hotel managers have no understanding of the financial health of their hotel. Ability to detect early warning signs is actually a leadership strength. But most hotel managers tend to ignore this critical leadership strength. Because of that, their promotion and elevation opportunities become limited by their own actions. I will show you how you can easily identify early warning signs of your hotel's financial health. You would want that, right? And we'll be using a very simple technique. However, your peers would not know about this, so you will have a head start on them. And this technique will boost your chances for promotions, elevations, and all kinds of opportunities. Now, you may have a question. Why me? I spent 26 years in the hotel industry in senior finance and leadership roles. I have myself detected hundreds of early warning indicators. Moreover, I have personally shared this with hotel managers and got them to identify them too. And that led to successful analysis and successful financial decisions. What if you are able to get a prior warning about the business performance? Wouldn't that be great? Particularly if it's something to do with your cash resources. Why is cash so important? Well, hotel needs to run its daily operation with cash. Liquidity ratios are those early warning signals that I talked about, the prior warning that you're getting. But what are these liquidity ratios? Let's find out. And before that, let's see what liquidity itself is as a concept. Liquidity simply means how quickly an asset can turn into cash. And now you can understand the cash resource importance. A hotel needs cash, obviously, to run its operation. And current assets of a hotel provide that much needed liquidity. But what are current assets, first of all? Let's take a look at the balance sheet of Paradise Hotel. Current assets form part of the balance sheet, and current assets provide cash resources. Hence, current assets end up providing liquidity. Current assets can include cash, short-term investments, accounts receivable, inventories, all of which we are going to see shortly. Let's first find out about the first type of liquidity ratio. Accounts receivable turnover ratio is one of the key liquidity ratios among hotel financial ratios. It uses accounts receivable and revenue KPIs of a hotel. So the formula for an accounts receivable turnover ratio is as follows. Total revenue divided by average accounts receivable. Some important explanations are in order on this formula. The total revenue that is shown in the formula is actually taken from the income statement, while the average accounts receivable is taken from the balance sheet. We are going to see how this works out. The accounts receivable turnover ratio is using two financial statements, the income statement and the balance sheet, for its calculation. While if you remember, the current ratio in the previous video used only the balance sheet. Let's now get to the total revenue calculation. The total revenue calculation is as follows and taken from the Paradise Hotel income statement. Total revenue is taken here in the formula instead of credit revenue. And why is that? Well, credit revenue is a revenue that is not settled in cash. And generally, uncollected credit revenue becomes accounts receivable. Number two, let's see how average accounts receivable works out. We will use the 31st December 2019 and 2018 for this calculation. But notice that the formula says average accounts receivable. Why does it do that? Well, the formula is actually averaging the opening and closing accounts receivable balances between the 2 years, which we saw earlier as 31st December 2019 and 2018. Why is it taking an average? Well, if accounts receivable opening and closing balances are either too high or too low, that will skew the accounts receivable turnover ratio, and that's the reason. So the formula averages by taking a midpoint, which is a much better measure. Let's see how the formula looks with the numbers themselves. So total revenue is 1,645,814 taken from the income statement and divided by average accounts receivable taken from the balance sheet, taking the 2019 and the 2018 accounts receivable balances, adding them together and dividing by 2. And that results in 115,000. So what does the formula result in? It results in 14.31. What does an accounts receivable turnover ratio of 14,000 mean? Well, it means total revenue is 14.31 times average accounts receivable. And in the case of accounts receivable turnover ratios, the higher the ratio, the better. However, there is actually a simpler way to show accounts receivable turnover ratio, which many beginner hotel managers may not really understand. So the better way to understand the accounts receivable turnover ratio is by using collection period. How many days it takes to collect accounts receivable, since it's a matter of ultimately deciding how quickly you're collecting your accounts receivable. Now, why is this better? The formula for this average collection period is 365 days, which is simply the days in the year, divided by the accounts receivable turnover ratio itself, which we just calculated. So in our case, it's 365 divided by 14.31, and that yields 25.51 days. What does that mean? Well, it means that it takes 25.51 days to collect accounts receivable balances on an average. Now, recollect what we said in the beginning of the video. The normal credit period for the hotel industry is 30 days. And what does that mean? Well, debtors must pay within 30 days. Compare that with the average collection period we just calculated, 25.51 days. It simply means Paradise Hotel is doing a great job of collecting accounts receivable balances. Now, let's revisit the role of the credit department. The credit department is one responsible for collections. It also means they are responsible for managing accounts receivables. Generally, accounts receivable balances should not increase from year to year. This is because when AR balances increase, collection decreases. And when collection decreases, cash flow decreases too. This brings us to a very important question, which is very relevant for you. How do we improve this average collection period? Let's look at 3 critical strategies. Number 1, ensure that your hotel is preparing and sending invoices on time within 48 hours of stay. And why is this? The faster the invoices reach the debtors, the faster the collection efforts can begin. Number 2, and this is often a problem in the hotel industry, confirm with debtors that the invoices have been received. Often the mail service is found defective and invoices may not reach the debtors on time. The earlier the debtors confirm invoices receipt, the faster the collection efforts can be made. And finally, make sure that the hotel collection efforts by the credit department begins by the 10th day of stay. The quicker the collection efforts started, the faster the collections can be made. See what are the takeaways on the accounts receivable turnover ratio. Number 1, it's total revenue divided by average accounts receivable. The average collection period is a better indication of this ratio. And number 3, faster collection begins with the prompt invoices and collection efforts. Would you want to learn more about the power of hotel financial ratios as early warning systems? More importantly, click on the video above on the ultimate guide on hotel financial ratios.